Imagine having a special insurance policy for your investments. One that not only protects you but also lets you profit when the market falls. Just like how a cricket team has a wicket keeper to stop the ball from crossing the boundaries. In trading, we have something called as a put option, our financial safety net. Let me explain with a simple example. Imagine Virat Kohli buys a new brand bat for 30,000 rupees. Now, what if he could get a guarantee that he could sell it for 30,000 rupees no matter what? Even if the value of the bat drops to 15,000, he still gets the full price of it. Sounds great, right? That's exactly how a put option works in stock trading. A put options give you the right to sell a stock at a specific price with a specific time period, no matter where the market moves. So, for example, if Reliance is trading at 2000 rupees per share, you buy a put option with a strike price of 2000. This gives you the right to sell Reliance at a 2000 rupees even if the price crashes. Let's take some scenarios. Scenarios number 1. Reliance falls to 1800. In this case, you buy Reliance from the market at 1800 and you sell it at 2000 using your put option. That's a 200 minus 50 rupees which you paid for the premium, which will give you a profit of 150 rupees per share. It's like match winning 6 in the last over. Scenario number 2. Let's say Reliance rises to 2200. You have the right to sell it at 2000, but you are not obligated to do it. The option simply expires and your only loss is the premium paid. This is the beauty of put option. No risk beyond the premium and massive protection when things go wrong. So what is the key takeaway? Buy put options when you are bearish on a stock. Put options are powerful tools, not only just for speculation, but also for hedging and protecting your capital. Alright, let's test what you have learned with 5 quick questions. Question number 1. What is put option in trading? Option A, the right to buy a stock at a predetermined price. Option B, the right to sell a stock at a predetermined price. Option C, the obligation to buy a stock. या is it option D, the right to hold a stock indefinitely? और इसका जवाब है option B, the right to sell a stock at a predetermined price. Question number 2. What happens if the stock price drops below the strike price of a put option? Option A. You can buy the stock at a lower market price and sell it at a strike price. Option B. You will lose all the premium paid for the option. या फिर option C. You must sell the stock at a current market price. या फिर option D. The option expires worthless. और इसका सही जवाब है option A. You can buy the stock at a lower market price and sell it at a strike price. Question number 3. In a put option, what is the premium? Option A, the price you pay to buy the option. Option B, the profit you make from the trade. Option C, the strike price of an option. Option D, the market price of the stock. और इसका आंसर है option A, the price you pay to buy the option. Question number 4. What is the break-even point when buying an put option? Option A, strike price plus premium. Option B, strike price minus premium. ऑप्शन सी मार्केट प्राइस माइनस प्रीमियम या फिर ऑप्शन डी मार्केट प्राइस प्लस प्रीमियम और इसका सही जवाब है ऑप्शन बी स्ट्राइक प्राइस माइनस प्रीमियम. क्वेश्चन नंबर 5. व्हाट इज द मेन बेनिफिट ऑफ यूजिंग द put option in trading? Option A, unlimited profit potential. Option B, protection from falling stock prices. Option C, guaranteed profit in all market conditions. या फिर option D, the obligation to sell the stock at a set price. And the answer is option B, protection from a falling stock prices. Share your quiz score in the comments. I'll personally check them and guide you on your journey because learning together makes us stronger traders. If you found this video helpful, share it with someone who needs to protect their trades or learn about bearish strategies. Until then, keep learning, keep winning.